Welcome to the Economist in Your Ear podcast. If you're building the future of artificial intelligence, which is the smarter bet, to own every single component, from the customized silicon chip right up to the final consumer product, or is it better maybe to rely on a network of world-class flexible partners? That strategic choice is really at the heart of this huge contest playing out right now between Google, Alphabet, and Microsoft. We've been looking at recent analysis framing this not just as, who builds the best AI model,
Right.
but as a really deep strategic fight over the whole architecture of the future AI economy. Is it going to be open or completely proprietary?
Exactly. This is about the dominant business model for the next decade, probably longer. Will it be these highly integrated sort of closed stacks or more modular mix and match systems? And wow, investor sentiment on who's winning this has swung back and forth like crazy over the last couple of years.
Yeah, it really has.
Yeah.
So let's start with the model that kind of emerged first, the one people often call the division of labor strategy. This really set the scene right after ChatGPT launched back in late 2022.
Mm-hmm. It was a pretty clear breakdown back then. You had chip makers, NVIDIA mostly, designing and selling the GPUs, the real engines.
Right.
Then you had these specialized AI labs, OpenAI, Anthropic, creating the big foundation models. And then the cloud providers, Microsoft Azure, Amazon, AWS, hosting it all, renting out the power.
And Microsoft, they were seen as the absolute masters of that model early on.
Yeah.
Leveraging that exclusive partnership with OpenAI just transformed them.
Sure.
They went from being, a solid, maybe slightly dull company
Dependable.
to suddenly the hottest thing in big tech.
And the results were just immediate, weren't they? Staggering. Microsoft generated, over $2 trillion in shareholder value since ChatGPT hit? That deal created this massive strategic moat, but it was built on controlling the ecosystem, not necessarily owning the hardware itself.
And when you dig into the details of that OpenAI partnership, you see just how deep that moat really is.
Oh, it's incredibly comprehensive. Microsoft has a 27% stake in OpenAI. They get 20% of the startup's revenue plus access to all the tech until 2032. And crucially, OpenAI committed to spending something like $250 billion on Microsoft's cloud.
Wow.
That's a huge revenue stream locked in, just reinforcing that whole partnership model.
Meanwhile, over at Google, the perception, as the analysis notes, was the complete opposite initially, even though they had all the pieces, right?
Yeah.
DeepMind, they published the seminal Transformer paper in 2017. They had their own custom chips, the TPUs.
Yeah, all the ingredients.
They were still branded the AI laggard.
Mm-hmm. It seemed like bureaucratic inertia, mostly. A lot of fear, apparently, about cannibalizing their golden goose, the search business.
Right, the cash cow.
That hesitation meant their competing launch was delayed until February 2023. And the market noticed. The valuation gap just blew out. Alphabet's shares were trading at, only 2/3 of Microsoft's relative to earnings for a while there?
Okay, so that sets the stage. But here's where the counter-narrative starts to build and where the market seems to be, maybe rethinking that initial division of labor idea. Google's strategy, that totally vertically integrated stack, is now apparently winning over investors.
Yeah, Google's approach is pretty unique among the tech giants because they really do control the whole thing. They design their own chips, the TPUs, tensor processing units.
Right.
Their models, like Gemini, built by Google DeepMind, optimized just for those TPUs. It all runs on Google Cloud and then powers their own massive product search, YouTube.
And the numbers recently certainly show huge momentum shifting back. Alphabet gained, $1 trillion in market value in just 4 months.
Astonishing speed.
Closing that valuation gap with Microsoft really fast. So what's the specific evidence making people think this vertical model is structurally better now?
Well, it really boils down to cost and control. The cost advantage argument is absolutely central to Google's whole vertical play.
Yeah.
Because they design the chips specifically for their software, for their model architecture, they can achieve, massive optimization.
And that customization, that's so key for their main business, isn't it? I remember those early estimates suggesting AI queries could cost like 5 times more than a traditional search click. That would just kill their margins.
Exactly. That was the big fear. But because of this vertical integration, Google's internal estimate reportedly is that the cost per AI query is only about twice that of old school search.
Okay, much more manageable.
Way more manageable. This frugality means rolling out AI doesn't completely gut their incredibly profitable search margin. It drops it slightly, maybe from 90% gross margin down to, say, 86%. That structural efficiency lets them deploy AI widely without destroying their main revenue engine.
And it seems like others are noticing that efficiency too, not just Google using it internally.
Yes, the market seems to be validating the hardware to some extent. Anthropic, a major competitor to OpenAI, actually committed to buying access to potentially 1 million TPUs from Google Cloud.
Interesting.
So even though they're rivals in the model space, Anthropic is choosing Google's compute because those custom chips are apparently very efficient for training these huge, energy-hungry models. That takes enormous capital.
That kind of cost control is definitely compelling. It supports the idea that integration gives you structural protection. But let's, push back a bit here. Does integration really guarantee long-term success? Wasn't the very cost and complexity of that integration why Google seems slow initially?
That's a really crucial point. Vertical integration means huge fixed costs. It means you risk getting locked into your own legacy systems, and it can make pivoting much slower. Google was less nimble early on, precisely because changing direction meant potentially retooling the whole stack, chips, software models. Microsoft's partnership model, well, it offers speed, flexibility.
Risk distribution, too.
And risk distribution, exactly. They aren't carrying the R&D burden for every single component themselves.
And should we really take those margin estimates, dropping from 90% to only 86% at face value? They seem to depend entirely on assumptions about how people will actually use search with AI, right?
Mm-hmm.
The analysis says search ad growth is still humming along at 10% year on year.
Mm-hmm.
But what if these AI overviews, giving direct answers, end up meaning fewer clicks on ads or fewer ad slots available overall?
That is the core structural threat that, simple margin math doesn't fully capture. The worry isn't just the cost per query. It's whether AI fundamentally changes the user behavior that generates those incredible 90% margins in the first place. That's the big question, whether you're running on a TPU or a GPU.
Okay, another point of caution. Investor behavior. That narrowing valuation gap is often presented as like proof Google's strategy is working. But is it really validation or just the market correcting an overreaction?
It could easily just be sentiment swinging back, couldn't it? If investors initially panicked after ChatGPT, thinking search was dead overnight, they probably priced in way too much risk.
Right, maybe irrational risk.
Exactly. So as the quarterly results come in showing maybe slower, more manageable changes, the valuation just naturally drifts back towards historical levels. That doesn't necessarily mean TPUs are inherently superior for all time, just that the sky wasn't falling immediately.
And beyond the business models themselves, we have to consider the external risks. Regulatory risk seems like it could be a much bigger headache for the vertically integrated player, right?
Absolutely. As Google ties everything together, search dominance, cloud services, custom hardware, it just becomes a much bigger, juicier target for antitrust regulators worried about dominance and maybe anti-competitive bundling.
Whereas Microsoft's approach is more distributed.
It's more hybrid, yeah. Even though they dominate in enterprise software, the AI stack looks less like one single monolithic entity. It might just present a slightly harder target for regulators to pin down.
And we can't ignore the elephant in the room, the sheer amount of money being spent, the capital expenditure risk. Big tech might spend over $300 billion on AI infrastructure in 2025 alone. That's just mind-boggling.
It really is. It screams potential AI infrastructure bubble, doesn't it? Eventually, the returns have to justify that kind of outlay. If they don't materialize fast enough, or if the tech gets outdated quickly, well, maybe the real advantage isn't owning the metal, but controlling the capital and the data flows needed to keep it all running.
Looking ahead, maybe the most interesting thing coming out of this analysis is how the lines are blurring. Both companies seem to be adopting bits of the other's strategy.
Yeah, Microsoft is definitely moving a bit googly. They saw the potential cost savings and optimization from owning the hardware, so they announced their own in-house chip design studio back in 2023. That's basically admitting that relying solely on NVIDIA GPUs is probably financially unsustainable at this scale.
And even OpenAI, Microsoft's big partner, is reportedly looking into custom silicon too, trying to, quote, staunch multi-billion-dollar losses. That tells you a lot about the cost pressures of just renting compute power.
This convergence suggests the end game probably isn't one pure model totally winning out. We're likely heading for a really contested multiplayer AI stack where different, maybe hybrid models coexist. The key question then becomes, okay, what's the real bottleneck going forward?
Is it going to be controlling the unique, specialized data you need to train the next generation of truly powerful models? Or is it maybe more about controlling developer engagement?
Sure.
Because historically, that's often what determines which platform wins out.
That could be the decider. That choice between Google's kind of closed stack offering tight control and internal efficiency versus Microsoft's ecosystem approach fostering more flexibility and maybe more third-party innovation. Which approach ultimately attracts the most developers, the most talent, and builds the strongest, most lasting network effects? That tension, cost, and control versus flexibility and ecosystem, that's really going to define the next 5 years, I think.
So given these absolutely colossal ongoing capital costs needed just to keep these AI systems running, maybe the true structural advantage in this AI era isn't really owning the hardware, but simply controlling the flow of capital and the vast networks of data that feed these giant systems. Something for you to think about as you watch this fascinating rivalry continue to unfold. Thanks for listening. Follow us for daily insights into world affairs, and don't forget to like, comment, and share.